So the number one question that I get asked as a real estate professional is, how is the market? So we're right in the middle of 2024, and we brought Bill Bacque back on Real Talk to see exactly where the market is today and where the Lafayette real estate market could be heading as we approach 2025. So Mr. Bacque, thank you so much for being here. As always, it's a pleasure to have you. And now we're mid-year 2024. It's been a very interesting year. We've had, so many different things happening, as we were just discussing with NAR and with the federal the interest rates and supply and demand. So what's going on?
Well, as I started this mid-year report, what I basically wanted to do was to say, well, let's check in and see how we are reacting to the tumultuous market that we've been in the last 4.5 years. So if you go to my opening page, and I know you'll edit that out, we see on the graph on the left-hand side, those are the transactions going back 50-something years. But to the verbiage, the reported home sales rose in Acadiana, rose by a little over 30% from 2019 to 2021, and you can see that skyrocket that's going up. And then we came out of that post-COVID period, and sales started to come back to normal. And we've seen over the next 2 years, from 22 through 23, that those sales then fell 29.7. So the key question coming into 24 is: are we still going down? Are we still in a market that is trying to find a bottom, or have we somewhat leveled out? Now, in January of this year, when we were doing our end of the year for 2023, we predicted that in 2024, we were going to level out. We were going to start to see that decline level and maybe even see a little rise. As a matter of fact, we had predicted in 2020 that 2024, the reported sales for the year would come in somewhere between 5,300 and 5,400. That would equate to approximately 1.7% to a 3.5% increase. So one of the things we want to do in looking at this report, now we're only halfway through the year, how are we doing relative to that? Now the other side of that is the dollar volume, which is the bottom graph. And we had the basic same thing happen. We had an increase in dollar volume of almost 58% over the period from 2019 through 2021. And then we saw about a 25% decline at the end of 2023. What do we think was going to happen in 2024? We thought there would be a roughly 5% increase in dollar volume. And we'd end up with about $1.3 billion. So how are we doing? You go to the next page, and through June, overall sales that have been reported to the multiple listing service are basically 2% ahead of where they were last year. We had predicted for the year anywhere from 1.7 to 3.6. The outside, though, of Lafayette Parish, the sales have increased by almost 5%. Now, when your overall sales outside of Lafayette are basically more than double what they in percentage rate increase than the overall sales, that's going to tell you that likely we took a little bit more of a beating in Lafayette Parish. And we'll see that when we get into the numbers a little later on.
Well, and I would imagine that is a result of, Lafayette Parish average sales price is higher than outside of Lafayette Parish, which means there's less demand, a higher price than outside of Lafayette.
That's certainly a factor. Okay, when we go to the next slide, you see the dollar volume. The dollar volume's up by about 1%. Outside Lafayette Parish, though, it's only up by 0.7%. So what's that's telling us is there's still activity outside of Lafayette Parish that's growing, but the dollar volume is not growing at quite that amount. So it kind of buttresses what you said, Jim, that maybe a lot of that demand that we're seeing outside of Lafayette Parish is price driven, and that's why we're not seeing the dollar volume increase at the same rate as the units are increasing.
And there's also a inventory variable. I don't know if you have that here, but it'd be interesting to see, like, based on the supply that is currently in the 300 and under or 350 and under versus outside of Lafayette Parish. There's just less houses in that price range.
You're right. But one thing we need to be careful of when we categorize, and certainly we're looking at what's going on outside Lafayette Parish. If you actually break it down by those outside Lafayette parishes, you'll see that there's not a continuity of that is, some are doing better than others. And so if you look at page number 5 of the next page of the presentation, we see that, like St. Landry Parish, the numbers were up almost 6% with volume up 2%. Vermilion Parish up 11% in sales and up 7% in dollar volume. Iberia Parish down 7% in units in transactions and down 2% in dollar volume. So you can see it varies. Now, the other thing that's been certainly contributing to the performance of outside parish residential transactions over the last few years has been the migration of new construction outside of Lafayette Parish. And so the next page, we talk about that new construction growth outside of Lafayette Parish. And guess what? First 6 months of this year, there's no growth. That is, the same number that have sold through June of last year are the same number of transactions that we've seen in new construction outside of Lafayette Parish. Conversely, though, we've seen an increase of 7% in transactions in Lafayette Parish. So there's an increase in new construction activity in Lafayette Parish. And as we can see, the overall outside of Lafayette Parish, of the total amount of new construction, that's done outside Lafayette Parish is about 28.8%. Last year it was 30.3%. So we've seen a little shift in new construction increasing in the Lafayette area. And we'll look at that in more detail when we get into Lafayette Parish. The next slide would be what a breakdown of these specific parishes. What's the one that has the most sales? As you can see, Vermilion, with the total dollar amount, about $18 million, and their average and median sales price. And when you go down through here, you brought this up, Jim. One of the things that makes the properties that are outside of Lafayette Parish maybe a little bit more attractive has been the ultimate average sales price and median sales price is lower outside of Lafayette Parish. Just to inject this, the average sales price in Lafayette through June is a little over $288,000. The median sales price is $249,500. Okay, so when you look at these, you can see 288 versus 239.6 versus the only one that's close is St. Martin.
That's crazy, yeah.
And
I would not have expected that.
Yeah. Well, they had some high-end subdivisions. New construction was contributed a lot to that. The next. We'll start zeroing in to Lafayette. And on slide number 9, or page number 9, we have the mid-year Lafayette. And as you can see, remember, overall, we were All sales were up 1.9%. In Lafayette, down. Well, it's essentially the same. 1,559 to 1,560 closed sales. 6/100ths of 1%. For all intents and purposes, a level market or the same market. Now, existing homes, though, are down 3%, and here's that new construction boom
Sure.
or writhe. They're up almost.
Well, that's not surprising because if you have an existing home, that means you probably have a low interest rate, so it's harder for you to sell. So there's less, it's going to be, in my mind, less inventory, which I know there is in certain areas. Now, we have more inventory than we had last year, but it's still 20+% less than what it was in 2019.
Right. Now, our dollar volume, remember, we're basically even as far as the number of transactions, but the dollar volume's up 1.20, which means that the average sales price is going to be slightly higher, as we'll see in just a minute. Existing homes are up 0.6%, new construction up 2.3 as far as dollar volume is concerned. Now, this is the interesting thing, if you turn to slide 12, okay, is where the price points are, okay? And as you can see, the under 150,000, that market declined, dropped by 10% over last year. But what's interesting to me is how much of our market is now comprised of under 150,000. And as we point out, it's a little over 12%. In the 150 to 299, 58%. And then the 300 and above, about 30%. Okay. Now, what's interesting, and I went back into the MLS in 25 years ago. Let me find that. (2019, 2014). In 2000, what did I do with that? Oh, here it is. Okay. (2019), 5 years ago, 4.5 years ago. Okay. In the under 150,000, we had 26, almost 27% of our transactions were below 150,000. Now they're 12.4, half that, okay? That's 5 years. In 2009, which would be what, 14 years ago, okay? Our total number of percentage under 150,000 was a third. So in 15 years, we've gone from a third of our transactions in Lafayette Parish being under 150,000 to now they're 12%. Okay, that's a concern, because one of the things that we all are challenged with is what's going to happen relative to the affordability, the American dream to begin owning a home, when the price or the average price or the has gone up as much as it has, and to where you can't find something, or your selection under 150,000 is dramatically lower. Now, we've seen that tectonic shift kind of move into the mid-ground area and into the upper area. But I do still have some concerns long-term as to how we are going to maintain affordability with interest rates still being where they are now, although they're come down a bit. But we're not anywhere near where we were 3 years ago as far as interest rates.
Sure.
They're about 300% higher.
Yeah.
And we've had the average sales price, which we're going to look at, and median sales price growth has been phenomenal over these last few years. And now it is coming down a bit, but not very much.
What do you think? Because a question that I get asked a lot is this a bubble? Do you see that it's an artificial increase in the price, and do you think we're in a bubble, or we're going to see a?
Well, that's an interesting point, and one of the slides that I have in this package, and it's on page 35. Now, this is the average price of a home in Acadiana, so it's not Lafayette, but since Lafayette makes up 80% of this, Lafayette's going to follow at least the trend line.
Sure.
Now, look at a couple of points. Go back into 2004, 2005, and you can see there was a 3-year period where prices went up. Okay, and then they did come down a bit, but more they just kind of stabilized for like a 4 to 5 year period. Then we started to see them rise again in that 2010, 2014 area, and then it dropped a little bit, and then we stabilized. Yeah. I predict, rather than seeing a significant change in the average price in a very short period of time, what we more likely are going to see is a period of basically stabilization of average sales price, where there's marginal growth for maybe 3 to 4 years to try to get that percentage increase
basically what we saw in 2015 and 19.
That's right.
Yeah,
that's right.
Where each year, and I remember we had you come talk to our team multiple times during that time, and you would laugh at me because I would say this year has been the greatest year we've ever had in Lafayette real estate, and it was, but it was only by like 1%.
Right.
You you had very small changes in number of sales. And that average price as well also stayed pretty much, as a small increase, but nothing to write home about.
I found this analysis pretty interesting too. If you look at beginning page 36, is to look at a comparison between the average sales price in Lafayette Parish over time. Okay, and so we go back to 2009, so that would be 15 years ago. And look at existing homes. The average sales price was $190,000. Now, if you go flip over to the next page, 37, you'll see that the average sales price in 2024, and that's really only 6 months, okay, is $276,000. Okay, if you go back to 190, we've had an $86,000 in 15 years growth in average sales price. Now, in that 5-year period between 2009 and 2014, you look for existing homes up $16,000. If you divide that by 8, that's 8.7%. But if you divide that by 5 years, the average growth during that flat line area was 1.7 a year. From 2014 to 2019, the average growth in existing homes, $6,602, 0.6% average per year. Then we get to the last 5 years, and we've seen that the existing homes went up 6.6%. That's double the rate of the annualized appreciation nationwide. Okay, so my point ultimately is we got ahead of ourselves, and even though we've been doing some correction on the numbers, well, heck, we dropped from a high of over 7,000 transactions to where we are last year, 5,000 something. We've had a significant drop in transactions. We've had a significant corresponding drop in dollar volume, although not as much. And what we haven't had is a significant decline in average sales price. But I do believe the pressure is going to go back to do more of what that minimal growth is for a period of years. But the one other interesting thing to talk about is, Jim, next year is an assessment year.
Oh, yeah, that's right. Yeah,
and we did our last valuation 4 years ago. Okay. Now, if you go 4 years from there, 2021 will be the comp year. Okay.
Right.
So one of the things property owners are going to have to look at in next year is what's going to happen to your assessed value, what's going to happen to your property tax bill,
Sure.
and what kind of impact is that going to have on your affordability and the affordability of a buyer who will also have to look at increased taxes as a result of that, and how much of that is we're going to then be locked in at those values for another 4 years.
Right.
Okay, so it is something to consider going into next year.
Well, and to talk about this increase in the last 5 years, it's not surprising because, I mean, price is a function of supply and demand, like we talked about earlier. The fact of the matter is over the last, before mid 2022. We had significant demand that was driven by lower interest rates.
Absolutely.
And that's what drove the prices, high in those 2020, 2021, and beginning of 2022. And then it maintained, even though interest rates dropped. Typically, in a normal situation, when you have a interest rate increase, it's going to drop the demand. And we did see that. But we didn't see a corresponding price reduction, because we had so little supply.
And we still, relatively speaking, we still do.
Yeah.
As a matter of fact.
And that's what's keeping the price where it's at now. I mean, there's just not as much supply as demand, which is keeping that price where it is now. I guess I see only two scenarios play out. Either prices, the interest rates go up or stay where they are, and eventually supply will increase with the lack of demand, or if we see a change in that interest rate to 6.5 or even 6.25, we could see increased demand. But are we going to see the corresponding supply?
Well, it's an interesting point, and again, one of the measurements that we look at for that dynamic between supply and demand is how many existing listings are there out there. What is the body of available properties? And on page 24, we basically do what give you what we call the number of months supply analysis, which is based on the amount of sales that have occurred versus the inventory that's available at any one given time, which in this case would be the end of June of this year. So you can see that the number of months supply overall for properties in Lafayette Parish is now 4.3 months. Last year, it was 2.9 months. And then if you break it down into various price components, we can see that, for example, under $150,000, there's a 2.4 month supply of property.
Well, and this is a good slide too. 23 just tells you like a balanced market is 5 to 6 months.
Yes,
so,
6 months.
Anything under.
So we're moving there.
We're moving there because we're in a high rate environment.
Exactly.
And that's what's causing that. But also, there is a supply aspect of that. What I'm finding out, like out in the field, we have in the upper end price range houses, let's just say 500,000 for instance. It doesn't mean there's not demand in that price range. However, that buyer who's going to buy a $500,000 house most likely, or is very likely, going to have to sell the house that they're in,
Right.
which they have a 2.5-3% interest rate. So they have to make that decision to release that to buy the next home. They're not first-time home buyers typically.
Right.
So that's creating the low supply in the $400,000 price range or keeping the supply low because they're what I call the golden handcuff. They don't want to move from a 3% interest rate to a 6.5-7% interest.
Yes, and that certainly is something that figures into their decision making. On the other side of that, although they have to give up a lower interest rate, they find themselves, if they've been in that property now for, let's say, 7-8 years, that their equity position has suddenly risen substantially.
6% a year.
And perhaps they are, if they're following the market, seeing that maybe there's going to be a period where that growth is not going to be as rapid and might make the decision, hey, this might be a good time. Also, pointing out that when you go from generalities, 4.3 months overall,
yes,
and you start breaking it down into price points. So look, if you look again under 150,000, it's 2.4 months.
Yeah, 25.
Okay. Now, one other thing is you can see there were 77 active listings in the under 150,000. This is on page 25.
Yep.
Okay, that 77 active listings are 88% more than the number of active listings we had just a year ago in that price point. Okay, so you can certainly see that there is a movement of inventory upward. In that 150 to 299, where we have the majority of our sales, 3.7 month supply property. 558 active listings, that's 65% more than the number of active listings we had at mid-year last year. The number of months supply last year in this price quadrant was 2.3.
But how much is that? And I'm sure you have this, like in 150 to 299. How much difference is that from 2019?
Well, I do have 2018 that I brought in.
Which was very similar.
Very similar. So if I go to that.
So we had 3.7 months of supply and 150 to 300.
150 to 300 in 150 to 299, 999. In 2018, there were 843 active listings at that time.
Months of inventory?
5 months.
Yeah, so we're still not to the level of inventories pre-COVID, and we should expect that to take some time. It's just all predicated on that interest rate and the environment that we're going to be in.
Okay. Then we go to the 300 and up. The 300 and up, 474 active listings. On December 31st of 2018, there were 449. So basically the same, okay? In 2018, there was a 9.9 month supply of product. We're now at 6.1 months. But you need to look at some of these points, when you break it down, like you were talking about the 500 to 550, you have a 6.6 month supply of product there. Okay. In the 600 or 550 to 599 goes to 7.9 months. So we're getting back into certain areas where it's going to get crowded.
900 to a million, you've got only 8 months.
Yeah,
it's kind of all over the place.
It is,
and I can tell you from like what our team is saying and what we talk about in our sales meeting is there's buyers that are in every one of these price ranges, and there's not the right house for them yet.
Right.
So and that takes me to, when we're trying to figure out where demand is, one way to look at it is like the houses that are that are sold or going pending instantly, there seems to be that still is a very high percentage.
Right.
That when that house comes up, if you're not looking, if you don't have the right strategy, or you're not working with a realtor, and when that right house comes, I mean, it's either, if it's a good price and it's in the right area, you still will have multiple offers on a good house that could be $900,000
Right.
or more.
Right.
But that also tells you the inventory that's out there now, if it hasn't sold in the last 90 to 100 days, or even more, maybe some of them are 200 days on the market, their price is not correct what the market is telling them.
Right. And again, part of the causal reasons for this may well be that, again, a lot of the properties that may have been in another price quadrant 5 years ago have now suddenly been moved into this quadrant. And what you might have been able to buy for $250,000 5 years ago is now above $300,000. Sure. And you're just not, at some point in your buying process, I would say maybe that's I'm being too strict. I think it's in every point. When you're out looking for a house, you're looking for a house. Okay, so it's got to meet the things that you need and want and desire, and the old saying, what we were saying when the rates were high, is you got to fall in love with the house and date the rate. Well, it's not about the rate; it's about the house.
Right.
Okay, and if you've got the right house that fits all the needs, it rings all the bells, then people will in fact buy it. Sure. And there are plenty of people out there with money that can do it, or the financial capability.
There's just less. There's less buyers. There's a lower buyer pool because of the interest rate, because some of those buyers are sellers, and some of those sellers haven't made that commitment to move yet, because they're in a low interest rate. And since the interest rates are high right now, they're not putting their house up for sale, and they're also not buying.
This is one in your slide you've probably seen before, and that's the number of transactions. It goes back to last year, and we know from looking at the data here that we're basically about equal with where we were last year, 1.9. This is Lafayette, so we're a little bit lower than we were as far as numbers through half year. But my point is, if you bring your hand down for last year, you'd have to go back 10 years to find that level of demand. Okay, that's the hit on the transaction side. The dollar volume decline, you only have to go back to 2020.
Right.
Okay. And that shows you what happened during COVID. Prices went up crazy, and now we're basically sitting here and doing this, waiting for those prices to come down either, or interest rates to come down to impact the demand. At this level of demand, we may end up, in our predictions, seeing the market a little bit behind what we predicted it would be at the beginning of the year, but not significantly. But you're right. Selection, price, cost of money, insurance, potential tax increases, ad valorem taxes, are all going to put pressure on the demand side, and it may not impact somebody who's well within the margins, but on any price increase or cost of ownership increase, you're always going to impact people at the margins. People who are at this threshold to qualify for the house they want, and now something happens and it moves them out.
Well, we just saw a slight decrease in the interest rates, and we saw that at the beginning of the year. It makes a big difference. From the difference between 7.25% interest and interest rate, and then a 6.5% is a big difference for the buyers.
Yeah, no doubt.
Yeah. And so depending on where we end up, at the beginning of the year, we thought all of the signs were that we were going to see possibly in the upper fives by the end of this year. And then obviously that's not going to happen. But some of the things I'm reading, they do seem to be trending down, and we should find out more in September where we're going to end up for the rest of the year, which, it's got me thinking people are still, they're still having babies. They're still, growing families. They're still getting jobs. Those things are still happening. So you got to believe that there's some pent up demand there that hasn't been released because of the interest rates.
Yeah, I agree. But
certainly there's pent up supply.
It's how much is your expectations for a movement to move you. If you're looking for a 2.5-3% interest rate to get you back into home shopping, I would tell you my humble estimation, it ain't going to happen. Okay, you're not going to see that again.
Right.
Again. Okay. I looked at the interest rates and I agree that I think we're in a declining interest rate environment, at least for the rest of the year. We predicted that 30-year rates will be in the 5.75 to 6.5% range by year end. Leaning more toward...
That was at the beginning of the year?
That's
or now?
Now.
Oh, so you think it's possible to get to 5.75?
It's possible.
Yeah.
Okay, I'm leaning more toward the 6.5, 6.25.
Yeah.
We're at 6.875 right now, I think yesterday. So we've broken that 7% mark, and I think we'll stay that way. Because the Fed has, from all indications, is ready to start moving that interest rate, prime interest rate to federal Fed's rate downward.
So in order to have a bubble, we would have to see an increase in supply and a decrease in the price for us to really see that. At least, do you see any kind of signs that that's what we're coming to? And I would imagine
not in the fundamentals here.
Right.
What you look at is, that's the unknown, is some kind of major economic catastrophe that happens, something like that, a natural disaster, a major hurricane, something like that could impact.
It would have to impact jobs.
That would be it.
Because the data that we are seeing here, there's no way there's signs of some huge supply increase unless people are losing their jobs for some reason, which could happen. We always want to keep an eye on it.
Well, but the news, it doesn't seem to indicate that that's what we're looking at. And we have somewhat of a lethargic oil and gas industry now, but who knows what's going to happen there. We have, our medical community is blowing and going. We just heard the news about the major plant that's going to be built in Iberia Parish, creating 100 some odd jobs. There are some positive economic news on the horizon, not a whole lot of negative economic news, but if you want to ask the question, what could impact our housing industry significantly, it would have to be the underlying economic health of our area.
Because it's a different situation than we were dealing with in 2008, because that was driven. The reason why that was a bubble was because there was people couldn't afford the houses they were buying. They were giving the money to buyers who couldn't afford the payments, which in turn created a bubble. We're not seeing that. Like, our buyers who are buying houses can buy houses and they have enough money to pay their note, whereas back in 2006, 5, 6, 7, we were in a place where there was less restrictions and lenders were giving out money when they probably shouldn't have, and the buyers couldn't pay for it, so then they had to foreclose, driving the prices down. Is basically what we saw. So, but this is a completely different scenario. Where the buyers that have bought in the last, really 10 years, they can afford the properties.
Yeah.
And so unless they lose their job, there is no signs of a huge influx of supply.
I would agree with that.
So what do you think given all of this information, what should we be looking for? If you're a buyer or a seller, what would you be telling them?
Well, for a buyer, it would be inventory in many price points is increasing, and so your selection is there, and your negotiating capability increases when you have more competition that is competing with the person you're negotiating with. So I think all those things and the potential for lower interest rates along the horizon, but not significantly lower, so you sit back and wait. Well, I'm going to wait till it gets to 4.
Yeah, not going to happen.
Don't do that because you're likely not to live in a house. Or certainly not live in the house you want. So I think that's what I would say to a buyer, that you're going to get increasing, not substantially, but reasonably increasing inventory selections and somewhat strengthening of your negotiating position. For a seller, I would say you need to forget about what people were talking about 3 years ago. Okay, and you need to be more cognizant of what's on the market right now that's competing in the price point that I'm offering my property at. And because you may find and may need to expect that you may not have 6 offers on the first day. Mm-hmm. And matter of fact, it might go a week and not be shown. Sure. You may get into those types of scenarios, and you need to divorce yourself from where we've been to get into the reality of where we are now.
And you should also, I think it's important from a seller perspective to understand your equity gain in the last 5 years. And if you have enough equity to power that move to get you to where you need to be, then it looks like to me we're not going to see prices increase significantly over the next few years. It's probably going to be, as you stated, it's going to probably be a very, balanced market moving forward.
I think we certainly deserve that. Okay. And one last little point relative to this, we took you through the average sales price over 15 years and 5-year increments. Average sales price, as you know, is just the total dollar volume divided by the transactions. Mm-hmm. So if you have a $3 or $4 million sale on the high end or a $50,000 sale on the low end, that impacts the average sales price or distorts it mm-hmm. somewhat from reality. And that's why a good many of the data analysts, like to follow median sales price, which is the middle one, and it's less impacted by the highs or the lows. The median sales price for Lafayette Parish is, as of June 30th, was $230,000.
Which page is that?
That's the page 39, second last page. $230,000. See the existing home for all homes is right at $250,000. $230,000 in 2019, 4.5 years ago, it was $184,900. So we've had a $50,000 increase in the median sales price. Okay, that's significant. And that's for an existing home. That's not building in the new construction. And you can see that $45,100 increase is 24.4% in 4.5 years. That's an average of 5.4% per year. Don't expect that ad infinitum. Mm-hmm. It's not sustainable.
Yeah, I mean, Louisiana's average over the last 2 decades is right at 3%. With the highs and the lows.
With the highs and the lows.
Yeah. Well, any final words?
Well, I guess the standard words that I've always used is that home ownership is more than an investment. It is an investment, but it's more than an investment. It's the center of your family life, of your family unit. And we've been through some challenging times where prices have gone up, availability is going down, and we're now finding ourselves in a market that's readjusting itself to try to find balance. To me, if you have in the near future, your needs include wanting a house, this is a good time to start looking, to be out there, to test the waters, and that you need somebody who is a professional guiding you that's got some depth of knowledge about the inventory available and the market conditions relative to what you are particularly looking for.
Yeah, I couldn't say it any better, Mr. Bacque. Thank you as always. You're incredible. Appreciate you so much. I'm grateful to have you here, and I'm glad you're still doing this.
I'm glad to have you as a friend.